Hello and welcome to The Bottom Line on TVP World. I'm your host, Marie Cato. This is where we unpack the main economic and business stories of the day. April 2025's World Economic Outlook delivered by the International Monetary Fund is certainly awaited for by industry and policy experts in light of recent global economic trends and developments. Tariff chaos implemented by Donald Trump, the soaring value of gold, the multifaceted challenges faced by the EU. Some of these are some of the themes behind what we can expect to see in the World Economic Outlook today. Let's go to Jan Kennedy's feature for some more context.
Trump's tariff turmoil continues to haunt the global economy, and the International Monetary Fund's latest spring outlook reflects the growing unease. The IMF has revised its global economic growth forecast downward, with the world economy now expected to grow by 2.8%. Down a substantial half a percentage point from just a few months ago, with the US and Eurozone economies both seeing 0.4 percentage point downward revisions.
Well, what we're seeing, of course, is a very significant impact of the new trade tensions between the US and a number of other countries. We've seen a flurry of tariff announcements since the end of January, with countermeasures from some countries. And all of that is very heavily coloring our outlook for this year and next year.
But with tariffs on hold and interest rates poised to be cut, economists reckon these won't be the final figures.
We are not sure what gonna bring us next day in terms of the tariffs and the level of tariffs. So probably in a few months, we will see the substantial revision of the economic forecast, especially in terms of the GDP, and also maybe in terms of the interest rates among Europe, USA, and probably in China.
Poland is expected to be moderately affected. The IMF now forecasts the country's GDP will grow by 3.2% in 2025, which is 0.3 percentage points lower than the fall estimate, but higher than the Polish government's worst scenario.
Poland is one of the least exposed EU countries, and where we come in is that we are exporting to the countries that are more exposed, and to calculate or to compute those effects is a bit difficult. But it comes down to something like half a percentage point of GDP at maximum in a negative scenario.
The uncertainty has also spilled into foreign exchange markets, and since the beginning of the month, the US dollar has substantially weakened against other currencies.
All the investors decide to move from the United States assets. They are start preserving the US dollar as less safe currency, and they are putting the money into euro. In fact, that's why we observe the situation that also Polish zloty weakened to euro.
Meanwhile, gold, widely considered as a safe haven in turbulent times, has been one of the biggest beneficiaries of the current uncertainty.
It hasn't been economics that's been driving the gold price this year. It's been very much the reaction to the political announcements and decisions that have been taking place. Now, this obviously will have an economic impact later in the year, but already, as I say, gold has done better than we were expecting.
Having surpassed the barrier of $3,200 per ounce earlier this month, at one point on Tuesday it neared $3,500. And once again, economists are pointing fingers at Trump.
This can be clearly seen in the reactions on the gold market. Gold has reached a new all-time high of $3,500. Donald Trump's treatment of his central bank chief is almost reminiscent of the situation in Turkey, where President Erdogan also treats the central bank as he pleases.
Economists have another explanation for gold's rally. It's been used as leverage for stock transactions.
Price of gold decreased rapidly, and then start going up and reaching the level around almost 3,500 US dollar. And what does it mean? All the short position on equity markets probably was leveraged in gold. So when the investor starts buying once again, the leverage is still on the gold. So they took the gold from the market, and the price is, of course, rising in this case.
The open question is whether the Trump factor will continue rocking the global markets, even if the trade war dust begins to settle.
So the World Economic Outlook that comes out today suggests the global economy should work constructively to promote a stable and predictable trade environment, facilitate debt restructuring, and address shared challenges. Perhaps a slightly different approach to what we have seen coming out of the White House in recent weeks upon hearing tariff announcements. Or perhaps we just need a moment to get some clarity on the details. Let's wait and see. We are now joined online by Professor Witold Orłowski, economist from Vistula University here in Warsaw, to share his observations on the report released today. Hello, and thank you very much for joining us again.
Hello.
So, global growth is projected to drop to 2.8% in 2025 and 3% in 2026, down from 3.3% for both years in January 2025, according to the World Economic update, corresponding to a cumulative downgrade of about 0.8 percentage points and much below the historical average of 3.7% in 2000 and 2019. I wanted to get your perspective. According to your experts' understanding of this report, how concerning are these figures?
The figures are not concerning very much. I mean, the commentary is much more concerning. And obviously there's no surprise in that, because what the IMF says is something like, those are the numbers. Normally we present so-called baseline scenario, what we expect to happen. And at this moment, we are unable to produce any baseline scenario. We are just making a simulation scenario. Means, let's assume that tariffs stay as they are. Already there is some impact on the economy. But do we know that they will stay as they are? We have no idea, they say. Because, well, let me remind you that the tariff increase for the majority of countries in the world are just suspended for 90 days. I mean, it used to be 90 days. Now it's less than 90 days.
But there is hope that there will be some negotiations, right?
Yes, but we don't know the outcome. Basically, this scenario is made by the IMF under the assumption that the current level of tariffs, they are only applied really to the Chinese. I mean, high tariffs are only applied to the Chinese, the import from China, imports. Well, 10% tariffs globally, but China is punished with some 145%, if I remember, with the exception of the domestic appliances, electronics, and so on, because immediately the price in the United States would have doubled if they wanted really to charge this tariffs on the Chinese import goods. So, in fact, the IMF is telling, we don't know. Let's hope, let's cross the fingers, let's hope that this is going to be the last. As they say, normally with the forecast, we give a forecast and then some downside risk and upside hopes, right? Upside hopes means, let's imagine that something will go better and the growth must be faster. Downside risk are, okay, let's imagine that may happen and then the growth may be even slower. And basically in the commentary to this forecast, the IMF is telling, okay, this is not even a baseline scenario. This is a simulation scenario based on the knowledge of today, assuming that what is today will continue without the knowledge, but with multiple downside risks.
So are you saying that the figures we're seeing at the moment are based on the tariffs, that the main impact comes from the tariffs, but at the moment we still don't know the full extent of the tariffs that have been imposed by Donald Trump earlier this year?
Exactly.
Earlier this month, rather.
What we see already is the uncertainty in the global economy, and it also has got a price in the form of slower growth. Interestingly, the IMF is following basically many other economists telling that the slowdown of the growth will be as painful for the United States as for its trading partners. So basically telling Mr. Trump is wrong, thinking that if he applies the tariffs, the rest of the world will pay and cry, and the United States will flourish. On the contrary, everybody will cry, including the United States. There are multiple risks behind, because let me come back to the point, what if the negotiations are not leading to a reasonable solution? What if there is a further increase of tariffs? The result is also the increase of the inflation, the rapid increase of inflation in the United States. You mentioned already in your information part of the program about the tensions between the President Trump and the Fed, the central bank of the United States. Now President Trump is more and more accusing the central bank, kind of finding this is the guilty of the fact that I'm governing the U.S. for 3 months. I promised a miracle, an economic miracle immediately, and there's no miracle. Why? Because the Fed doesn't want to cut the interest rates. The Fed will not cut the interest rate, especially if there is a risk of the further increase of the inflation because of the tariffs.
But would you not agree that the volatility that we see on the global market cannot just be ascribed to the tariffs that have been coming out of the U.S.?
No, this is you should first of all link it to the uncertainty, not even to the tariffs, to the uncertainty. You know, for example, stock exchange, finance. I mean, it hates the uncertainty. Mm-hmm. As people sometimes say, whatever bad news are reaching the Wall Street or in Warsaw, the stock exchange, once the investors know what they should expect, in a sense, they calculate it in the prices and somehow they start living with that. The worst situation for the global finance is uncertainty. And basically, frankly speaking, I don't buy this story about the gold being used for a leverage. No, the buying of gold normally means people are afraid of the future. People do not know what will be the return from the normal paper assets, and therefore they decide to pay whatever price is necessary to make sure that this is a safe asset. And gold is a safe asset simply.
But I just wanted to focus on, now that you've brought up gold, the currency and exchange rates and the capital flows, because economies are facing debt distress and gold has hit the highest forecast price of $3,500. Does this come to you as a surprise? Because, you know, we have heard commentaries that the result of this is the political turmoil, not necessarily the economic turmoil. And do you think that we can expect a higher price in the weeks to come? Because the last expert we had in the studio said that $3,500 would be the maximum price that gold would go up to. What do you think?
No idea, frankly speaking. I mean, the market experts are always expected to give you the price, the quotation a month from now. Frankly speaking, that depends on the situation globally, and basically, first of all, on the situation with the tariffs, but not only the tensions in the U.S. between the Fed and the government, the president. Is also something very disturbing. This is the story in which the changes of the in finance, basically, of various assets, so on and so on, are first of all maybe unexpected. Secondly, it means that there is the growing feeling of the risk in the global economy, and the point is that the risk is hurting the most the countries or the companies that are heavily indebted and so on. And the IMF is already telling that we don't know what will be exactly the change of the exchange rates, for example. But one may be sure that whoever is heavily indebted may have troubles. Whatever is the as far as as long as the uncertainty is growing. So there is a risk of major financial problems for many countries if this turmoil is continuing. But basically, as I said, whoever is heavily indebted may have reasons to be afraid of what's going to happen. Fortunately, Poland is not heavily indebted.
Well, speaking of Poland, the US dollar is coming up to 3.8 to the dollar rather, and it's been the strongest since May 2021, which is quite significant news. What does this tell us about the dollar, but also what is happening vis-a-vis the euro and the zloty in general from the dollar perspective?
First of all, about the dollar, because it's interesting, because President Trump has announced a set of policies that were to improve the position of the United States vis-a-vis the rest of the world. I mean, putting the weight of the economic, political power of the United States behind this attempt to get better conditions on everything, right? And normally in such a situation, you would expect the dollar to appreciate. I mean, if the other countries will have problems with exporting to the US, the dollar should become stronger. And the reaction of the markets was such that rather than attracting the capital was clearly fleeing the United States, and the result was the weakening of the dollar rather than strengthening of the dollar. This is a paradox. It's showing to what extent the markets did not buy the story Mr. Trump told them. The same was, by the way, with the stock exchange. I mean, the American stock exchange was losing as much as any other stock exchange in the world, despite the fact that theoretically, as Mr. Trump seemed believed, he was proposing something that would be only in favor for the benefit of the U.S. entities, for the United States as an economy. But basically, the financial market read it in the totally opposite way, and the result is a relatively weak dollar and But if we look at zloty at that time, we must remember that zloty is also one of the so-called emerging market currencies, means currencies that are considered much more risky as an asset than the dollar and the euro. So basically, the first effect is the dollar, rather than gaining vis-a-vis the euro, has lost something vis-a-vis the euro, but currencies from the emerging markets basically were losing because the uncertainty in the global economy increased. And this is as a result, what is a bit weaker. There's nothing big has happened, right? I mean, we still got the impression that everybody's waiting for the result of those negotiations between Europe, especially Europe, obviously, and the United States about the tariffs. But basically, the first reaction was, making dollar weaker, euro more expensive, zloty a bit weaker vis-a-vis the euro, but not vis-a-vis the dollar. Will it continue? That depends on the situation. Today, it's too many unknowns to make any credible forecast.
Just as we wrap up, I wanted to ask you about the general economic turmoil that we're facing and your recommendations as to what countries should do in a more practical way, because the report suggests that there should be work done constructively to promote a stable and predictable trade environment, whatever that actually means, to facilitate debt structuring and to address shared challenges, but to also address domestic policy and structural imbalances to ensure internal economic stability. What does that actually mean, given that we are in such volatile global circumstances?
Well,
what would your recommendations be, just quickly as we wrap up?
I mean, the first point is, obviously, we are not the country that is very much exposed. We are neither highly indebted. Our currency is relatively, we are not very much exposed to the exports in the United States. So, but let's expect problems as everybody if the situation doesn't go down. And given that, obviously, Poland must continue the work on strengthening its fundamentals, so its competitiveness. And the fundamentals of the competitiveness depend now on the ability of Poland to increase the investment and to improve the productivity and technological level of the economy. So for us, it's not a short-term task. I mean, what's telling us is let's work even harder to make the competitiveness of the Polish economy bigger and not based just on the cheaper labor or something like that, but rather on the growing technological level of the economy.
Okay, Professor Witold Orłowski, economist from Bristol University, thank you so much for joining us again. Thank you very much. And that concludes The Bottom Line for today. I was your host, Marie Cato. We're on every weekday at 5:10 CET on TVP World. And in the meantime, for the latest in regional business, follow us on X and on tvpworld.com. And for more news and analysis, stay with us on TVP World. Goodbye.